We have less than 10 minutes left in the trading day for the day and for the week. Time now for the big picture. For that, I want to welcome in Michelle Gilbey, Director of International Research, Charles Schwab. Michelle, thank you so much for spending time with us this afternoon. Happy Friday. All right, let's dive right in with a look at, we had some new PMI data. What does it tell you about the state of the global economy?
Yeah, we got the purchasing manager data for manufacturing and services across many economies globally, and it showed that the global economy slowed as the quarter ended. The PMI for the U.S. surprised by strengthening rather than slowing, but manufacturing in Japan and Eurozone slowed, as did services in many economies. Inflation, though, is still a little bumpy. It's not moving in a straight line lower. And so central banks are moving cautiously. Now, we had the ECB, they cut rates in June, but they're likely on hold next month. And the Bank of England this week held rates, but they could cut at its next meeting. But, we believe the cutting cycle is still likely to start this year for most developed market central banks. And the cuts will be because inflation is lower and not because economic growth slowed. But this is a positive for equities, but we could still get some uncertainty over the timing of cuts. And also global elections could result in further market volatility.
What are you expecting for economic growth for the second half of the year, globally speaking?
Yeah, it's going to be a pretty good year, frankly. We had, for instance, the Eurozone and several other economies in recession last year, and that's not the case this year. But, things are just a little bit slower as we start the second half.
And then with you anticipating the cutting cycle to start for developed markets, so we've already seen some cuts overseas. What's your anticipation of how that impacts equities?
Well, I mean, rate cuts would be positive for most equity markets. But, again, it's a little bit uncertain in terms of timing because inflation isn't exactly moving in a straight line. The one big exception is in Japan, where they are starting to hike rates. And again, inflation here has been not really cooperating with them. It's taken a little bit longer for it to pick up speed. And there was some disappointment in the most recent meeting that QT was pushed out to July. And because of that, there's less likely to be a hike in July, but it's still possible.
I did an interview earlier today, and there was some critique of the Fed and the course it's taken. Should the Fed be taking more cues from moves overseas, like we saw a Swiss central bank cutting rates, for instance? Should the Fed be moving faster?
Yeah, I mean, in Switzerland, the CPI is down below 2%, so it makes sense for them to be cutting rates. We're not there yet in the U.S. Each economy has to, take into account their own domestic factors when setting policy. Even the ECB, they're cutting rates because they believe that they are on track to hit their 2% inflation target.
And then, Michelle, what are you watching for in global markets in the week ahead?
Yeah, we will get some inflation data in Europe as well as in Japan. Those will be preliminary June figures. But probably the biggest factor for markets will likely be French politics. And they're likely to remain in headlines because markets are focused on the implications for increased fiscal spending. So we have a two-round election. It starts June 30th. It's likely to have the far right versus the far left in the second round on July 7th because Macron's party, centrist party, is currently last in the polls. Now, there is some similarities to the Eurozone debt crisis in 2011, but it's not a repeat. No one is calling to leave the euro. Banks are better capitalized. And it's actually possible that markets could force fiscal prudence, as we saw in the UK when Liz Truss proposed higher spending in 2022. It's important to put this current spread widening in context. French 10-year government bond yields over German yields are only 75 basis points, and that's up 30 basis points. Of that 30 basis points, 15 is from French yields rising, and the other 15 is because German yields have fallen on a flight to safety. So, this uncertainty could impact the French economy, but it's not likely a crisis.
All right, Michelle Gilbey, Director of International Research for Charles Schwab. Thank you for the insight on the global economy and the picture for equities.